In the late January of 2026, something crazy happened in the precious metals market. A crash so sudden, so violent, it left the entire financial world scrambling and asking one question: what on earth just happened? In this explainer, we're going to unpack exactly what went down, why it happened, and what it might mean for the future. To really get your head around the scale of this thing, you just need to know one number: $15 trillion. In just 48 hours, $15 trillion in paper value was just erased. To put that in perspective, that's like half of the entire US economy for a year. Gone. Poof. So, how did this all unfold? Well, the timeline tells a pretty wild story. On January 29th, the market was absolutely flying. Gold hit a record high, over $5,500 an ounce. Then, just 2 days later, bam, the Friday massacre. We are talking about the worst single-day drop for precious metals in over 40 years. By February 3rd, things started to stabilize a bit, but the damage was done. And the $15 trillion question was, why? All right, so let's dig into this, piece by piece. We're going to start by looking at the anatomy of the event itself, the $15 trillion crash. I mean, you have to ask, right? What in the world could trigger a collapse this big? A market move like this isn't just a random blip on the radar or some technical glitch. No, this is an earthquake. It requires a fundamental, ground-shaking catalyst. So, what was it? Well, the answer, in a nutshell, is that a new sheriff was coming to town. You see, for months, the market had been this free-for-all, a kind of Wild West party fueled by easy money and speculation. And then, all of a sudden, the lights came on and the party was over. And that new sheriff? He has a name. The event is now known as the Warsh Shock. On January 30th, the news dropped. Kevin Warsh was the nominee to be the next chair of the Federal Reserve. And that one name was the trigger, the single match that lit the fuse and sent a shockwave through the entire financial system. What's so incredible here is the complete 180 in market thinking. Before the nomination, as you can see on the left, everybody expected the easy money party to just keep rolling. More rate cuts, a weaker dollar, the whole 9 yards. But the Warsh nomination slammed on the brakes, hard. See, Warsh is known as a monetary hawk. He's someone who favors higher interest rates to fight inflation. So literally overnight, the conversation went from rate cuts to rate hikes. The dollar shot up, and that whole easy money story just evaporated. But here's where it gets really complicated. The Warsh Shock wasn't the only force at play, not by a long shot. To really understand the chaos, you have to see that there was this massive tug of war going on in the background, with all these other global worries pulling the market in completely opposite directions. So on one side of the rope, you had all these huge geopolitical events that were basically creating a safety net under prices. You had the US slapping tariffs on European allies over the Greenland dispute, talk of a Golden Dome shield, and the capture of Venezuela's president. All this stuff kept the world on edge, you know? And when the world's on edge, people want safe haven assets like gold and silver. This is what kept prices from just falling through the floor entirely. But pulling just as hard in the other direction were some really powerful headwinds. The stronger US dollar, thanks to the Warsh news, makes precious metals way more expensive for anybody buying with foreign currency. Then you add in some surprisingly strong US economic data and some hints of a diplomatic breakthrough with Iran. And suddenly, the need for that safe haven starts to look a little less urgent. This created a price ceiling, putting incredible downward pressure on the market. Amidst all this chaos, the crash revealed a really fascinating disconnect in the global market. The story kind of splits in two here: a huge divide between the paper markets in the West and the physical markets in the East. And this slide right here shows that divide perfectly. On February 3rd, while Western markets were in full-on panic mode, the price for actual physical silver in Shanghai was over $96 an ounce. In London, it was under 83. That is a stunning 16% premium. So while speculators in the West were panic-selling paper contracts, which are basically just IOUs for future metal, buyers in China were aggressively buying up every bar of actual physical metal they could get their hands on. So why the huge premium? It all points to a structural supply shortage. China's massive build-out of AI and solar infrastructure requires a ton of physical silver. And when you can't get enough of something, what do? You pay more for it. Buyers there were willing to pay that huge premium to get the actual metal, not just a paper promise from the West. This disconnect between paper and physical brings us to the most controversial theory about the crash. Some analysts believe this wasn't just a reaction to the news, but something more deliberate. As one analyst put it, it was a brutal rescue operation of the system. So, here's the allegation broken down into 4 steps. First, at silver's peak price, major banks had these massive short positions. They were betting the price would go down, and they were facing over $10 billion in losses. Second, these losses were so big, they posed a real risk to the whole system. Third, the Warsh Shock provided the perfect cover, creating a massive panic. And fourth, in the middle of all that chaos, JP Morgan reportedly closed out its entire $10 billion short position at the exact bottom of the market, a rescue operation, or the most perfectly timed coincidence in history. We report, you decide. So let's pull all these threads together. The policy shock, the geopolitical tug of war, the paper versus physical divide, and the institutional maneuvering. What does it all mean for the future? Well, it points to something analysts are now calling the Great Market Reset. Now, from the institutional perspective, this violent crash was actually seen as a good thing. They view it as a healthy and necessary event that washed out all the excessive speculation and leverage, borrowed money, that had built up. In their eyes, it just cleared the deck for a more stable market. And if you need proof of that clearing the deck viewpoint, just look at this. After the worst crash in 40 years, are the big banks scared? Not a chance. JP Morgan is targeting $6,300 gold. Bank of America sees silver potentially tripling from its lows. They don't see the crash as the end of the bull market. They see it as a fantastic buying opportunity before the next major leg up. Which leaves us with one final critical question. The $15 trillion reset is complete. The excessive leverage has been wiped out. But was this a one-time cleansing that put the market on a more stable footing, or was it just a symptom of a deeply fragile system? And is this just the calm before an even bigger storm? That is the question every single investor is now asking.